Hey, how's it going, everybody? Anmol here. Welcome to another edition of the Swing Trade Newsletter. Wow, what a last week in the markets. We had the quickest drop since the 2008 financial crisis. Markets went down almost 13 to 15% for the year in literally 1 week. Now, it's not a big decline, right? It's a small decline, but it's the fastest that the markets ever declined like this since the financial crisis of 2008. Now, a lot of it is overblown, right? Most of the decline happened due to two majority reasons. One, Bernie Sanders was gaining lead in pretty much every single poll, so people thought, hey, if he's going to get elected, the economy is going to crash, it's going to be bad for business, and all of that, which is true. Based on that was one of the reasons, but the biggest reasons that the market kind of came in was due to the coronavirus fears, right? Coronavirus got really big in China, then cases were detected in Italy. So, first the news of China, then the news of Italy, then the news of Iran, and then some cases in the United States, and then the CDC coming out and saying there's going to be more cases. So, a lot of that, caused this panic sell off that we recently saw. Right now, it's nothing to be surprised about technically because here's how the news works, right? The news doesn't really work based on what they know to be true, right? What happens is when market goes up, they search what's the positive news, right? And they say, oh, that's the news why it went up, right? And when the market goes down, they're like, what's the news? Why could it go down? They search for negative news, and then they're like, hey, that's the negative news why it going down. But as you guys know, that's not how the markets work. Markets are created of two primary emotions, fear and greed. And what simply happened was that the emotion of fear took over, and then that caused this panic sell off. But is it a surprise? Is it a surprise the market came in? I hope not, because if you guys are in the newsletter, we literally talked about this exact same thing happening almost like a month ago. Remember, almost a month. I drew these lines a month ago, by the way. So when you see these lines on my chart, this isn't something I just drew right now, right? I literally drew these lines like almost a month ago in January. Before we even got there, I said, hey, this is the zone, right? 339, 340 area. That's the zone where we're going to start to see a decline and a pullback. And guess what? A pullback is what we got. So those of you who joined the newsletter just a few weeks ago, right? And maybe you missed out on that warning that I provided. I'm going to post some snippets of video snippets of the past video newsletters, right? Which I exactly talked about this scenario, right? And I told you guys this in, I think was it like in the middle of January, February, right? I said, hey, I am selling all my long-term investments. I've sold all my dividend stocks. I sold my hedge funds, my mutual funds, my index funds. I literally sold everything, you know, towards the middle of January is because I was expecting this, right? And guess what? Now I can buy it back like 15% cheaper. And that's what trading is. When most people don't know how the markets work, they don't know how to read charts. um, they get caught off guard, and these kind of things catches them by surprise, right? And we literally did our analysis and say that's the area we're going to see a decline, and that's the area that we got a decline. And I was able to get out of all my long-term trades, long-term investments, everything, right, and not get hurt. And guess what? Now I could buy them back 13 to 15% cheaper, right? And I also talked about how most kind of these crashes happen, right? When we had coronavirus fears, even right over here, right? When we pulled back, I said, this is nothing. This is not going to be a crash, right? This is not how tops are formed. Tops are usually formed with a rounding pattern and with a gap, right? And guess what? We got a rounding pattern, we got this gap, and then that's how this decline was created. So I hope that I was able to keep some of you guys out of trouble, right? I hope I was able to keep you guys out of the trouble, and maybe I helped you make some money while this decline and not get hurt, right? Because you could have got out of your long-term investments right over here at that zone, and you can always start buying them back again at these prices. So, that being said, what we have is a pretty high increase in volume, right? You can see here the volume candles very low as we went up. And I also talked about this, and this was one of my primary fears, right? You can watch the previous newsletters. I talked about it. Hey, we're going up, but we're going up on lowering volume. That's not what you want to see when a market is going up. You always want to see a market going up on high volume and not go up on light volume. And that's what we got. And now look at this, right? This is what you call real volume. So the volume has now picked up, and on Friday to close the week, we got the massive, like a really massive volume, the highest since like a long time. Yeah, this is the highest volume we've seen in a really long time on Friday. So this obviously might have created a short-term bottom. So on Monday, we'll see what happens on Monday, but this might have created a short-term bottom. Now, when I say short-term bottom, what I mean is that the market is guilty until proven innocent, right? So that's why when the markets are above all its key moving averages, right? That 9 is going up, 9 is above the 21, 21 above is the 50, right? Prices above all the moving averages. Then the prices are innocent until proven guilty. So any dips are buyable, right? But when now the prices are below all key moving averages are curling down, and the market's also below the 200 MA, it's guilty until proven innocent. Meaning, yes, it's probably a short-term bounce, right? You could get a bounce like that, but you have to be skeptical until the market gets and stays above the 200 period moving average, because it could very well just be a bounce, right? We go to 300, 304, 308 maybe, and then we roll back lower and create a lower high. So that could very well happen. So again, market's guilty until proven innocent. It's not a bad idea to start scaling back into your longs. So if you were following me and you kind of exited your long-term investments and stuff, not a bad place here to start buying it back. And I actually did. On Friday, I bought a little bit of my long-term investments back. Not all of it though. That's the key word, right? Like I exited 100%. I went fully cash in the end of January. Now I've put 25% back to work, right? So I've still not put 70% of my cash. I'm still keeping that cash in case something bigger happens, but I've started to put some money back into work and scale down as we drop lower. And the reason I'm, not really convinced is because when I look at the monthly charts of all these markets, right? You look at the spiders, big topping tail, engulfing candle, right? You look at the IWM, the Russell ETF, it's got a double top on a monthly time frame and a lower high. You look at the ETF of the NASDAQ, you see again, big topping tail, engulfing type of candle. So, this is sort of like a topping pattern in the big picture, okay? It is. It's a topping pattern on the big picture. So I actually think that there is further downside on the card. So not to scare you or anything, but when I look at this chart, I'm still not convinced. I still feel that a bigger pullback could be on the cards. But a good thing is on Friday, right, the Qs, if you look at the NASDAQ ETF, the NASDAQ actually pulled back to its 200 MA, huge volume and a green candle. So that's actually a pretty bullish sign for a short-term reversal, right? Short-term reversal. So we'll have to wait and see what happens when the market comes back into the 50% of this decline. So 50% of the decline probably brings you to like 217. So that's going to be a crucial area to watch. On NASDAQ, if NASDAQ gets back above like 218, then I think we're going to probably resume our uptrend again. But if we fail at 217, 218, you could get a lower high from this territory. And again, same thing you'll notice with the IWM, with the Russell ETF. Russell broke down under its 200 MA, but you are at some support here. So we got some clear levels on the Russell. This is our major area of support that you've held on Friday. So if you hold it next week, you go right back up, then great. We might resume our uptrend. But if we break this area, we're going down all the way there. No surprises, right? And same thing with the spiders is what I think is that, we got below the 200 MA. Now we have to reclaim it. So if the market ends up reclaiming the 200 MA and coming back above the 200 MA, I think we're going to just go right back up and resume our uptrend, right? Go to all-time high. But if we start failing at the 200 MA zone, then that could be very nasty for the market. By nasty, I mean we're probably going to test the lows of December of 2018, which is another, it's a pretty big drop from here. And not only that, I think if we get down to that level, we could enter a further decline. Notice this. Notice this here in from 2000, right? It took the market almost 2 years to recover, okay? 2 years to start trending back up. So 2 years of decline. And here you notice from 2008, right? 2008 to 2009. Again, another 1.5, 2 years of decline. So we haven't really got that recently. Recently, we've only been getting 1 month or 2 months of decline, right? So it could still be some things to go, but we talked about in the last newsletter that nothing can get extended from the moving averages. So here you see the uptrend lasted a long time. Why? Because it's hugging the 9 EMA. You notice here hugging the 9 EMA. Then here you got away from the 9 EMA. What happens? Pull back to the 9 EMA. You got extended from the 9 EMA. What happened? Pull back to the 9 EMA. Here you got extended again, and that's why I was like, hey, we're gonna pull back to the 9 EMA, and boom, we pulled back to the 21 EMA on the monthly, which is a good sign. It's a healthy correction, right? If it wants to go right back up again, but for some reason I'm still not just convinced. So again, we have to wait for price to confirm, right? After hours, we actually went up much higher. If you take a look at the extended hours chart, we actually went even further, almost back to $300 on the S&P. So if it holds true like this, Monday you can expect a gap up. But what's interesting is that the gap up is going to be around the 200 MA area, which is going to be interesting to see how it reacts. But for the bears, it's one thing is pretty clear, right? Here's your stop loss, right? So if you are long or you want to buy the market again, not a bad idea. You're risking one candle, right? Buy above that candle, stop loss below that candle. And if you go right back up, great. You're risking one candle. But this is the low of Friday. Mark that low of Friday, right? Really mark that. Set an alert. If you break the low of Friday, okay? Again, I repeat, if you break the low of Friday, we're dropping all the way down to 2018 lows. No doubt about that in my mind. So that's what's going to happen. So again, the Friday's low is going to be key for the market to hold. If you hold it, potentially we go all the way back up again. If you don't hold it, then it's trouble, right? And by trouble, I mean Great Depression. The next Great Depression, the recession, right? If we break that low, it's going to be nasty. It's going to be carnage, and we might enter 1 or 2 years of bear market. I don't think that's going to happen yet, right? But there's always a possibility, and that's why I say price pays, nothing else pays. Okay, so let's take a look at the market internals here. Taking a look at the market internals on the S&P. We talked about it. I use a couple internals here. Basically, I have these 3 moving averages that I use, and once we start getting below that, that's when I get bearish. So this is my 13 exponential moving average. So as long as the prices are holding that moving average, I usually stay long in the newsletter, right? When you start breaking that, I get concerned, right? So right here, we got concerned a little bit. We started putting short positions. We made money on it. We got back above it. I got out of my short positions. I went mostly long in the newsletter, right? And here, we broke down again the moving average. Guess what? We had no longs in the newsletter, only shorts. So, and that's kind of the situation. And you will notice here the McKellen oscillator is at a historic low. Literally, it's at extreme low, 239. And that's why on Friday, I told the chat room members in the day trading room that we're probably going to bounce today. And a bounce is what we got because we were extreme lows. So this suggests a short-term bottom, meaning that you could potentially get a couple days of upside. But again, that area is going to be key. If you reject here, you might come right back lower, right? But you'll notice this McKellen oscillator is usually pretty good at picking tops and bottoms. And you can, let me zoom out here. You will see here during the pullback of 2018 December, McKellen also hit an extreme low, and that marked the low of the market. All right, and here you'll notice on this decline, McKellen also hit an extreme low that marked a bottom. Here, when the market dipped below, McKellen also came back to oversold territory. We came back up again. On this decline, same thing happened. Now we're like way past that. And that's because we had the fastest decline, but it is extreme. So that could suggest that we might have a short-term bottom in place. By short-term bottom, I mean like for the next week or so. But again, that low of Friday is going to be super crucial to watch. As long as we hold that, I think we can go right back up again. We start breaking it, then all hell could break loose in the market, and just something to be very concerned about. So again, hopefully I was able to not only save you guys some money, but also make you money. Because if you had exited your long-term investments along when I was doing it right over here, now I could buy them back 15% cheaper. Right? That's how you make the real money. But the good news is we're still killing it in the newsletter. The S&P 500 is down, almost like 10% for the year, right? And it was down as much as 15% for the year. And at that same time, the newsletter is up almost 27, 28% for the year on just a 2% R unit. Even if you're risking 1% per trade, you're still up almost like 13, 14% in the newsletter. Whereas if you put your money in the market, you're down about 10% plus. So again, we've done a pretty phenomenal job here, and I want to keep it going. I think this could be a monster year for us in the newsletter. So again, stay tuned for that. That being said, the as far as the things are concerned, I want to talk about something real quick. And I talked about this and I touched upon it briefly before, is age groups, investing based on your age, right? Here's what I mean. So now if you are in your 20s, you are in your 30s, you are in your 40s, right? You got nothing to worry about. Like, these declines don't mean anything to you, just like this decline of 2019 didn't mean anything, right? The reason I say that is because let's say even if you're wrong, you put your money in the market right now, right? And you're dead wrong. We enter 1 or 2 years of bear market, right? But historically, the market always comes back up and you end up averaging 8%, 10% per year by putting your money in the market. So if you're in your 30s, 20s, 30s, 40s, 50s, you don't have much to worry about, right? Because you have the benefit of time. Meaning, you're wrong, we go into much, much lower in the bear market. Guess what? Over the next 5, 10 years, market will come right back up and you'll end up making money. So that's nothing wrong with that, right? So that you're fine. You don't need to worry about this. But now let's say you are somebody who is maybe either in retirement or close to retirement, maybe in your 60s, 70s, 80s, right? Now, unfortunately, you don't have the benefit of time to wait around, 3, 4, 5 years for the market to come back up. Because if you're in retirement, that probably means you don't have any other source of income, right? Unless there's some people who are retired, but they have real estate, they have other sources that money is coming in from, right? So you don't need that money. That's okay. But maybe if you are somebody who has a big nest egg, you don't necessarily have the benefit of time because you're retired and you need that money, right? Maybe for medical emergencies, for unforeseen circumstances, for whatever, right? For your day-to-day needs, you need that money. So you don't have the benefit of time. So for those people, what you should be doing is you should not be having all your money in the market, right? You should be having bonds, fixed income. You should have CDs. You should have, other forms of investment that are safer, right? That might not give you a return on your investment. You're not going to be aggressive, but your money's safe and you can pull your money out, and that's what you should be focusing on. Now, personally, for me, I am, as I said, even though I think the market could go right back up again, I am very concerned long term about the markets. So, just to reiterate, this is something I told everybody just about 2-3 weeks ago, that I have decided going forward that I am not going to be really getting in long term on the market, meaning I'm not really going to be getting in mutual funds, hedge funds, index funds, REITs, dividend stocks, or any of that. I'm moving 100% of my money into trading, meaning doing exactly what I'm talking about with you guys in the newsletter, right, with bigger position size. So I'll take every single trade I'm calling in the newsletter with my money. So I'll swing trade with my money. I'll trade Forex with my money. I'll day trade with money. But I want to be trading. Why? Because I can sleep well at night. Number one, I can get better return on my investment on my money than by investing, right? And number three, again, I avoid any unforeseen circumstances because we can go long and short. We keep trading, we keep making money. And this is a perfect example of it. If you put your money here into the work in the market in the beginning of the year, you're like, hey, look at me, I'm making much money. Boom. Oh, now you're losing money, right? Whereas in the newsletter, we're killing it. So personally, for me, I think, I hate to say it because I want people to invest, but I look at this chart and I'm like, I don't want to be in this chart. I don't want to be in this chart. And this is contrary to what everybody will tell you. And again, I do think market could go right back up again, but I just think that the returns that we're looking for might not exist here. And I think it's better use of your money to swing trade with your money, just increase your position size, right? So rather than investing, maybe you swing trade with a bigger position size. You day trade, you Forex trade, you move your money around, cash flow, be nimble, don't tie your money, get in and out, long and short, and you just you sleep well at night. I think that's what I think because if we do end up taking out these lows coming up, then I think something bad could happen. Now, as I said, that might not be this year. It could be 1 or 3 years away. But I'm sure that this decline that we saw is just the start of something bigger. Now that might take 1 year to happen, 2 year to happen, 3 year to happen, but I'm pretty much certain in the next 3 years there's going to be a nasty, nasty crash, and this crash will look like peanuts compared to what's actually going to happen, right? And I'm talking about like this monthly chart of Spider. I'm talking about a pullback at least till 200 to 210, which is like this big of a candle down, right? So I still believe that's on the cards for us in the next 1 to 3 years. So that's why I don't want any money on in the market. I want to be trading, right? So I want to be trading stocks in and out, in and out. Get take your money, like move your money around, just like what we've done in the newsletter. All right, so this is the newsletter results so far. So you can see here we made about 27.59% for the year with a 2% trade R unit. If you're risking 1%, then you made about 13.79. We actually were at 1 point over 15, but obviously we had a couple trades that I tried, like TLT, that didn't work out recently. So TLT was one I tried. A lot of people were asking why I was doing the TLT trade. I'll go over it right now. This is a trade I've been doing for many, many years. I've been right like 3 times already. Basically, you look at the monthly chart. Monthly chart was in a channel. So I made money here in 2014-15 shorting this. I made money again, in 16-17 shorting this. I made money buying TLT in like 2018-19. And I also made a little bit of money shorting it over here. And then I started the newsletter. We bought it here. And so we made money TLT all the while, right? Now I saw it coming back up into this channel. I shorted it. And this time we were wrong. And we got out. It's fine, right? Get in and out, right? Don't hold something. Although I do think that here's a possibility. If TLT ends up failing, and then let's say one of these days it comes back below this channel, I'm probably going to short it again because that's when we're going to see this pullback, just like it happened here. You will notice on this area here, it actually got above that channel, but then it came back below the channel and we died. And then same thing here. I think right now you're above it. So if it goes, let it go. Who cares? But if it comes back below that channel, then we reshort, put our stop loss, and then we'll probably come back down again. So I'll be keeping an eye on these bonds on the TLT. What's interesting was gold really took a hit on Friday. Usually what happens is that when markets go down, gold goes up, right? What's interesting is last week, gold also went down, market also went down. And it's, again, nothing to be surprised about because a lot of you guys were asking me, hey, Anmol, gold, shouldn't we go long here? I'm like, yeah, but technicals is what matters. Nothing can get away and stay away from the 9 EMA. Oh, that's actually a rhyme. Repeat after me. Nothing can stay away from the 9 EMA. So again, you see, we rallied up. 9 EMA is left behind. We came in, touched the 9 EMA. Boom, we popped up. 9 EMA is still down there. Market pulled back to the 9 EMA. Boom, we're extended. 9 EMA is left behind. Pull back to the 9 EMA. Then here, we got way extended from the 9 EMA. Guess what happens on Friday? Boom, big red candle back to the 9 EMA. So that's how, I don't have a crystal ball. I just follow price. This is the key. People ask me, like, how do you predict these things? I'm like, I don't. I follow my strategy. Nothing can stay away from the 9 EMA for too long, right? If it gets overextended, it will come down. Just like I said on Tesla, remember? Talked about it on Tesla. Tesla, yeah, you might go to 1,000, it might go higher than 1,000. Who cares? But nothing can stay away from the 9 EMA. Boom, back to the 9 EMA. So this is how you really call tops and bottoms. I don't have a crystal ball. I just follow the signs of the market. Okay, so that's the overall scenario as far as where we stand. I got a lot of questions about oil, potentially buying oil. Again, follow the price action, not what you think. And you will notice here that on a monthly chart, this is when back in the day I used to run the newsletter for a proprietary trading firm in New York. I used to do their newsletter, advise the clients and everything. And then I was called Crazy Anmol. They called me Crazy Anmol because here everybody was saying, hey, oil is at a historic low, right? Oil is going to go back up, limited amount of oil in the world, right? And I said, I actually see a bear flag that if you break it, we're going to go like to 5 or lower. And they said, Crazy Anmol, calling it, oil at historic lows, it's probably going to go higher. And then it dropped, and then nobody replied back, right? And then here, I said it again, it's at low, but this is a kind of like a bear setup, bear wedge here, right? You broke that bear wedge, and guess what? You're going down. Let's take a look at the daily chart real quick. So again, even though I think that oil is down a lot, I think it is due for a bounce, but I don't think it's going to be a big bounce because you take a look here. This was our support. You took out that support, right? You took out that support. That's why we dropped. That's why when people were buying over here, I was like, be careful. Got a little bounce back to the bear edge, pull back. Now, one good thing about oil right now is that it's sitting at a prior low, which is not a bad buying opportunity. But I do think that this buying opportunity will be a few days rally, and then you might continue lower because the other higher time frames as we looked at suggest there might be further downside. So I'm not a buyer in oil right now. Although if you want to trade it for a couple day bounce, it's not a bad idea. But I just don't see much of an edge in the markets at the moment. All right, so what else? Let's see. Take a look at Dow Jones here. Again, Dow Jones also back into this prior area of support. Big volumes, again, short-term bounce. But keep in mind, in bear markets, okay, the bounces are hard and fast. So in bear markets, the bounces are hard and fast, which make you think, oh my God, this is the bottom, and we're gonna go. And then you go and then you pull back, right? So, and you will notice that even just by looking at the market on a 15-minute chart, right? Let me remove extended hours here. Look at it on this day. Okay, see that? Look at it on this day. Market went down, all the way here to 305, went down to 297. From 297, we came all the way back to 310. Right here, we came down to 285. From 285 all the way back to 297. So the bounces on bear markets are pretty big. So again, all markets except for the Qs are below the 200 MA. So only the Qs is above it. Others are not. That's obviously not what you want to see. Let's take a look at the financial sector, XLF. You will see the financial sector also sold off with the market, which actually means that it confirmed the move of the market. You take a look at transport sector in deep trouble. Transport sector actually broke all key support levels. The next support level is down here into 2019 low, which also confirmed that market move. So there's a lot of confirmation happening here. So in my opinion, short-term bounce is on the cards. Long-term, I can't say yet until we, reclaim the 200 MA. But what's good with all these green candles is simple. You take out that low, you're going much lower. You take out the high, you're going to get a couple day bounce, and then we'll see what happens on the market. So, since we're still in a very volatile environment, I don't want to be calling too many swing trades. We've had a good run in the newsletter. I want to keep it that way by being selective. So even though I have a lot of stocks I'm watching right now, like I'll show you some of them. This one's interesting. Inflarex, IFRX. I think if this stock gets above, $5, it could probably go to $10, but I'm not convinced yet. This WVE, I think if it gets above $9, it goes to $12, but again, not convinced yet. Even stuff like TORC, I think if it gets above like $1.70, probably can go to $3. And then there's NNA, which I kind of like. NNA, little double bottom here on NNA. NNA, here's a double bottom right over here, right? If it gets back above this area of $5.25, probably goes to $6.50. So again, all these are stocks I'm watching, but I don't want to do yet. Even this one, TTNP, Titan Pharmaceuticals. I think if this stock gets above 32 cents, probably goes to 54 cents, a penny stock. But I'm not going to be calling these trades. As I said, I want to see more confirmation on the market. Another one I'm watching is Groupon, ERP. This stock got recently crushed on earnings, went down from like $2 all the way to almost becoming a penny stock to $1. I do think that if it can get back above $1.40, it might push up to maybe $1.70, $1.80. But again, I want to be waiting for more confirmation because usually when a stock sets a bottom, it gets huge volume. Volume's pretty low down here, so I'm not convinced this is the bottom yet. So I want to keep an eye on this Groupon, but it looks pretty good for a bounce. Another one I like is APRN, Blue Apron Holdings. This stock used to be like $100 and something stock. Yeah, $160 stock, down to like $2. And right down here, you're getting a lot of volume, which potentially suggests accumulation. And I also think that this company will, it's a buyout candidate at these prices. I'm not going to say much, but, One of my friends, he's trying to actually buy this whole company, but I don't know if the deal's ever going to go through. Probably not going to go through. But that doesn't mean anything, right? We don't trade based on news. Okay, we never trade based on news here. We always trade based on technicals. So I'm not going to buy this company. I want it to get back above 350. If it gets back above $3.50, then I'll look to maybe buy it, and then we can probably trade that buyout kind of news. But right now, it's not worth it. It's still below moving average. So that's one of the king. As when you're a trader, and I have a lot of hedge fund manager friends. I have a lot of people who run money management firms. They run private equity firms. So I get all sorts of news coming my way. And public information. I'm not talking about anything inside. I'm talking about potentially public information. But I never act on it. Why? Because technicals are number one. Price never lies, right? Anybody can lie to you. Your numbers, your charts never lie to you. So right now the technical is still in a downtrend, so I don't want to buy it. Simple as that. But if it gets back above, let's say 350, then I'll be interested in this stock. All right. Next one is this was brought to my attention by a member in the chat room, or probably also in the newsletter. GEL. So this stock got recently crushed. Went from like $22 to like almost $9. So I really like this big time increasing volume at the dead low. That definitely suggests the bottom and a move up. But I don't want to buy it yet because look at this candle here. The low is like 860, high is like 11. So that's a big stop loss. I don't think the reward to risk is in there. So maybe if we get like another small candle here, or like a green candle, then I'll consider like buying like this and trading it to the upside. But until that happens, again, just a watch list. I'm not buying it. All right. And then there's a few more things I'm watching, but nothing I'm actually liking right now. There's only two stocks I'm going to call for this week's newsletter. I'm only going to call two stocks. One of them we already traded in the past. We got into the stock around like $12.50, $13. We sold it on the pop at 15. Now I want to get back in this RAD, Rite Aid. So I would say long above 14.55, stop loss under 12, and then look for a bounce maybe into 19 or 20 on this RAD. So this sort of becomes like your W pattern, right? So this is one I'm going to call officially, but again, it has to prove itself and get back above 14.55. Next one I like is CRSP. This is again another trade we've already traded in the past in the newsletter. We got into this at 56 and got out around 61, which is a great trade. But now what I like about it is that it dipped below the 200 MA, and on Friday it reclaimed it with a big green engulfing candle, and that big green engulfing candle engulfed all these 5 days of candles. So I think that looks good to go higher on CRSP. And another thing I like about it is that you look at the weekly chart. Weekly chart is sitting at the 50 MA, nice bottoming tail, and overall the stock is in an uptrend. Lower high, higher low, higher high, higher low, higher high. This could be a higher low, which could take you back up into a higher high. So overall, this is in an uptrend, and I think this could go back up again. So I want to buy this thing long over Friday's high. So I will say 53.51 long, stop under Friday's low, and see if we can get 66, 67 on this stock. So that's that. What else? Recently closed trades. There are a couple trades we already locked in small profits on. CHRW. This was one we had in the newsletter as a short idea. But what I didn't like about it is I shorted it and the market crashed. And this one was going down, but very slow. So I was like, I'm not a big fan of it. I got out of it for a small profit, although it did go lower after. It didn't go down with the market, and I wasn't a big fan of that. Same thing with AVTR. This was another trade we did in the newsletter last week. We had, shorted this stock right over here, right over there, right? Put our stop loss right over there. We got a drop. I got out again too early. I always do that. You will notice the theme. So if you guys know, I don't overstay my welcome in choppy markets. I got out here, took my small profit, and eventually went lower and would have hit our target already, but that's okay. Same thing with another stock we made profit on, CDW, right? We shorted this stock, CDW, right over here on this bear wedge pattern. It dropped, and I got out here. Again, got out too soon, probably dropped down, towards our target, but that's okay. I don't overstay my welcome. And you cannot have it both ways, because I get emails sometimes, people saying, "Hey, Anmol, like a lot of stocks you get out on, and they're going lower." I'm like, that's true, right? That is true, but then you can have it both ways, right? Because I can also show you stocks that I got out on that actually, if you held it, would have stopped out. So you can't have it both ways, right? So, because I don't have a crystal ball, okay? So either you hold all trades or you get out of all trades as you feel like it. But you can't pick and choose, because guess what? Check this out, NBEV, right? We traded this twice, made money both times. Both times, if you held it, this trade actually would have stopped out, right? What else? The other one, remember SDC? We got into this twice, made money twice. Look at this. If he held it, would have stopped out. Remember SNDL, marijuana stock? We longed it here. We got out there. Look at this stock now. You would have stopped out. So there, I can show you thousands of trades in this newsletter, and you can go back and take a look what they would have done, right? And overall, I've actually done a pretty better job than actually holding stuff. So this is one of the things, you have to be nimble as a swing trader. You cannot be a rigid swing trader unless you have statistics to back that up. Okay, so you have to be nimble. I like to get in, give him a nice little size stop loss. They move in my favor, try and go break even real quick and limit my exposure. And you will notice here in the newsletter, not many full losses. We had a very, small losses here. Again, small losses, not even 1 hour losses. There's some that are 1 hour losses, but most of them I try to keep my losses not even 1 hour, right? So what happens is my reward to risk ratio actually still becomes pretty good, because I don't take too many full losses. I take small losses. I might also take small gains, although I do have a lot of 2-to-1 gains in the newsletter as well. So the Sharpe ratio is in the end what matters. And again, we've pretty much reached last year's newsletter results in literally 2 months, right? This is last year's newsletter results. We made 15 hours last year, all of last year. This year, we made that pretty much in like 2 months. So we're on track for a pretty much record year. You will notice that, there's a lot of people watching the newsletter. So that's what I talked about earlier, that if you, I don't want, like I know we get people all the time. They come in, they try the newsletter for a month or so, they take a trial. I might get rid of trials completely in the future, but because I don't want people to come in and do it for a month, right? Because you might join on a good month, you might get winners. You might join on a bad month, you get maybe, not a good trade. What matters is how you do long term. And I beat the market every single year. I've been doing the newsletter. I used to run the newsletter for some other advisory firms in the past, right? And then 2015, I started running this own one. 2015, I ran it. We beat the market. 16, we beat the market. 17, I beat the market. 18, I beat the market. 19 was a busy year for me, so I couldn't do the newsletter. Jared was doing it, right? And then 2020, I'm back again. And, we have a lot of people that follow the newsletter, right? We have a lot of people. We have a lot of hedge funds, mutual funds, money management firms, private family offices that subscribe to the newsletter. I got a whole group of people that, trade with me. And, they call me for, advice and everything. And that's why I'm doing the newsletter, for those people that I don't have to get on a phone call with them. I can do the newsletter, show you exactly what I'm doing. And we have a good amount of people. So just to let you guys know that if you do cancel the newsletter, nothing wrong with it. It might not be your style. Go ahead and do that. But there's going to be a price increase. But again, nothing for you guys to worry about. You guys that are signed up will not see a price increase. You will continue to remain at the current price that you have, but most likely the newsletter price is going to go up incrementally. So every few members I add, the newsletter price is going to go up, right? So we started the newsletter at $97 a month. We already have like thousands of members. So I'm going to increase the price probably to like $127. And then as we add more members, I'll increase it to $147, $190. I'll keep increasing it, because I actually don't want, you guys might not imagine, but contrary to what you guys think, I actually don't want too many members. Why? Because of slippage, right? So if I call a trade, sometimes I call a trade and it just pops, right? Because everybody's getting in. And I make way more money trading than doing this stuff. So to me, my trading is more important than anything else. I love you guys, but my trading is way more important. My fiduciary duty is to myself, my trading account, my investors. I also manage money for my friends, family, relatives, so I trade for them too. So when I call a stock and everybody start jumping in it, I might get filled late, right? Maybe instead of buying it at $4, I get it at $4.10. So that ruins my returns. So I don't think it's worth it for me to do this newsletter. So again, I'll do it, but there's probably going to be a price increase for any future members because I think it's ridiculous charging 97 for something that can make you that in in one trade, right? So I mean, a lot of people have said, "Hey, I signed up for your yearly newsletter at $997." Literally made that back 1 year of newsletter in one trade, which is great. But I don't want any more members. So that's that. And what else? Let me know if you guys have any questions. But as I said, very uncertain times we are in. Look at the VXX, the volatility ETF. All right, let me show you on this chart right here. Look at the volatility VXX. Again, fastest rise in a long time, since 2008. Right, since 2008, the VIX has risen this fast, and usually that's not a good sign. That shows immense fear in the markets, right? And that's what's caused this rapid sell-off is the fear and the uncertainty. Okay, so I still think that we are in very volatile waters. Please be cautious out there. Do not overtrade. And this is the first time in the newsletter that we actually have 0 open positions and 0 trades. And guess what? It's actually worked in our favor being that way. All right. So again, I'll keep you guys posted. But these are the only 2 trades we're looking at, CRSP and RAD for now. And I'll probably do another video next week. And during the week, I'll keep you posted. If I see something else, if the market sends me confirmation signals, then we might have more trades on the list to call. But again, keep an eye out for the updates on the emails. Have a good one, everybody.